Well, good evening, everybody, and thank you for that very kind introduction. And it is a great pleasure and a terrific honor on behalf of the Financial Times to be here today to have a chance to interview Chairman Alan Greenspan and Adrian Wooldridge about your latest book. Apparently, I have the English version, not the American version, but it's the same words and maybe not quite the same spelling, but there we go. But we're going to be talking about this book. I think neither man are in need of much introduction. Chairman Greenspan, I think as everyone in the room knows, was the luminary of economic policy making for many decades. You were chairman for 18 and a half years, apparently, of the Federal Reserve. The second longest chairman. You've also been an economist. You are now, at the age of 92, you've been author of 3 books. And I think one of the things that is most remarkable is that since you left the Fed, your interest in chasing down economic mysteries, in accepting areas where you need to learn more or where you actually have a chance to rediscover ideas and test frameworks, has remained completely undimmed. You epitomize curiosity. And that's something which has driven you to write the book, and I'm going to talk about in a minute. Adrian Wooldridge is a fellow British journalist. I think it means, Chairman Greenspan, that you are officially outnumbered tonight on the stage.
That's okay, it's even. 2-1 Brit, US, we're even.
Right, well. Adrian, for those of you who don't know, is with The Economist magazine. His normal day job is political editor. He writes what's called the Budget column. So if any of you feel like tossing a question about Brexit later on, you do have the cards. But he has been co-authoring this book with Chairman Greenspan for about 3 years. Is that right?
Yes.
Yes. So it's very much a labor of love. It's very much a labor of inquiry and curiosity. But I'd like to start by asking you, Chairman Greenspan, the book is called Capitalism in America, a History. Some people might say, why bother to talk about capitalism in America? Because everyone knows that America is capitalist, isn't it?
Well, it is, yes, but the point at issue is that the history of the United States is extraordinary in the sense that we started just on the edges of North America with Plymouth and basically just going through around a little bit down to Virginia. And we ended up with, a very short period of time, the most important industrial power in the world. And it's an extraordinary story, and it's not self-evidently going to occur that way. And we even find that the entrepreneurship which exists at the core of all business is still there in the United States, in the sense that we've been through an awful lot, and now we're back on top with respect to the transistor, all of the electronic systems that come as a consequence of that, and are still the largest major economy in the world.
So what made you write this particular book at this moment?
Oh, well, it's a phone call from my publisher. He said,
well, that wins prizes for honesty, but I mean, but.
Well, he called me and he said, we have a job for you. We'd like you to write an economic history of the United States. And I said to him, but wait a second, I am not a historian. He says, look, we're your publisher, we're your editor, you are a historian. But, and besides, I've asked Adrian Wooldridge of The Economist to join you, and I said, that's terrific. And we've had 3 years of remarkable I don't know, we don't even argue, which is the most extraordinary thing, is that I had expected to run into a problem where, since my views I know are very idiosyncratic in certain respects, that I would never find somebody with whom I could find a coincidence of ideas. And I don't think we've really argued. We had one small argument very recently. He won, so I won't tell you what it was.
Well, maybe Adrian can tell us later. So you set out to write an economic history of the United States. In many ways, this is a remarkable book because it not only sets out a very clear intellectual framework for how you've seen America develop, and I'll come on to that in a minute. It also has the most unbelievable amount of astonishing statistics, which frankly I didn't know about aspects of American development. I mean, if anybody ever wants to play Trivial Pursuit with your family in this coming vacation season, this is the perfect book to win with, because every single statistic you can imagine, which no one else knows about how America has developed, is in here. Any particular fascinating statistic or numbers you discovered as you researched the history of America?
A lot of them. Where do you want me to start? Well, first, what we did is decide that what is going to be the central core of the book. And it turns out to be creative destruction, which is a Schumpeterian the concept. He never evolved it into anything. But what creative destruction basically is creating the new from the old. And it's just as fascinating to evaluate the creative part as the destruction part. I mean, for example, a major forward advance in steel industry in the United States occurred as a consequence of the Bessemer furnace, which is a British, a Brit who got Andrew Carnegie so excited about what it was he was producing that he rebuilt his whole steel company around this new novel type of steel making, which is a major advance. And the interesting part of it is that if you were going to do what he was doing, it was essential that you destroy all of the things that was essentially competing with it. And what you can say about creative destruction is it's at the root of productivity, because you've got a situation in which so long as output per hour is rising, the economy is growing, but how much it is rising is very critical. And the best way of describing it is that in virtually all cases, it's been a major decline in unit cost of production. What it is, for example, that the Bessemer furnace did was essentially obsoleted a whole series of steelmaking processes. And eventually, the Bessemer furnace itself got pushed aside by the open hearth furnace, for example. So there's always something which falls away the same time you're evaluating something.
So you
and that basically means that unit costs are going down, and that is the way productivity is created mainly, and it explains to a very large extent why the United States is where we are. And one of the things we do in the book is we construct a whole new series of output per hour, and we do a little bit of mathematical analysis. And there's a thing called multi-factor productivity, which is an aspect of productivity which essentially measures innovation.
Right.
And what you can see throughout the decades is the extraordinary effect of innovation up to this day.
It's great because, I mean, governments love to talk about growth. They love to talk about innovation and creating things. Most governments don't want to talk about destruction, do they?
Absolutely. I mean, one of the things we tried to do in this book was to have 1, 2, possibly 3 interesting facts on every page, because I think a lot of economic history is written by economists who are obsessed by models, who are obsessed by very abstract arguments. And what we tried to do all the way through was actually look at the granularity of things, look at the particularity of things, look at the strange facts. So to answer your earlier question about interesting facts, I think one is that the average cow in 1800 would produce about a 16th as much milk as the average cow now. We think of productivity growth as being something to do with industrial processes, but in fact, in agriculture, you've seen an extraordinary change in the productivity of
animals. So we have hyper cows.
Hyper cows today. Another interesting fact, I think, is that when the post office, with the origins of commercial airlines, the first sort of first use of airlines in this country was by the post office to deliver mail to far-flung places like Alaska. And of the first 30 postmen who flew these planes, of the first 40 postmen who flew these planes, 30 were killed in action. You know, it's an incredible destruction rate. And another thing that I liked,
not in a very creative way.
Not a very creative way. Another thing I liked was that the first a train in this country was brought in from England, and it was called the Stourbridge Lion, which I like. As my family came from Stourbridge, I rather like this idea of the Stourbridge Lion starting off this huge industry of trains and railroads in this country. But I think on the destructive side, we argue that the key to America is that it has a high tolerance of creative destruction. And that doesn't mean just accepting creation, which is an obviously wonderful thing, but it means tolerating destruction. And I think one of the problems with a lot of other countries, particularly European countries and our own country of Britain, is we want the creation without the destruction. And if you want creation without destruction, you tend to get neither of them, or you tend to get very slow, laggardly growth. And America's willingness to see that destruction, and some of it has been ugly, and some of it's been very difficult, but that willingness ultimately leads to high productivity.
I mean, Chairman Greenspan, do you think that America today is as willing to accept and celebrate destruction as it has been in the past? I'm going to come back and ask you a bit more about the history in a second, but I'm curious about this because this is really one of your key messages, that you cannot have growth without destruction.
Yeah. Well, I think one of the most fascinating parts of this book, and in fact American history really, is the fact that you get destruction, but it doesn't matter for a while because it's too small to be an issue. But as you get into the second half of the 19th century, after the Civil War, it's very apparent that the people who are part of the destruction part of the I guess the best way of putting it is the huge number of people who are associated with those businesses which are obsoleted by the new innovations. They create a major advance in, I guess you can say, the development of unions, because when the first half of the 19th century, there were no workers, there were craftsmen, and there were people who didn't want to join what we now call as unions. But as we got into the post-Civil War period, we got larger and larger corporations and more a distinction between employer and employee. And the whole notion developed about unions, and it's really an extraordinary history, which is part of this book. I mean, what we do is we look at the creative part, and we do it largely in terms of productivity and and essentially it's various different aspects and what causes it. We go into the economics of it, and there's a lot of data in this book, but I think it's useful to understand how the system works. And the key turning point is a very remarkable period. It's William Jennings Bryan. William Jennings Bryan in 1896 was a fairly young 36-year-old Nebraskan who got up in the middle of that particular, I guess you could say, association of the Democratic Party, and it was one of those extraordinary events which turned politics around. The Democratic Party was a highly conservative party prior to then, and essentially is characterized by presidents who thought that the least government, the best. It was essentially laissez-faire. He got up, Bryan got up and made this extraordinary speech, which is now historical, and the Cross of Gold speech about the American worker and the American farmer being crucified on a cross of gold, gold being the gold standard. And that propelled him, strangely enough, into the head of the party. He got nominated. He never became president because he kept losing. I think he went 3 times and failed each time, but left a very major, indelible stamp, which led to Woodrow Wilson and all the way through to Franklin Roosevelt. And I look at Bryan as the root of Franklin Roosevelt's New Deal.
Well, that's fascinating, because I think most people, that part of it's often been obscured in history. It's again one of the reasons why this book is so interesting, because it throws up these interesting connections.
I would add one qualification to that, because I don't think opposition to creative destruction just comes from, as it were, from the left, from the Democratic Party, from trade unions. It also comes from business, from incumbent businesses. Incumbent businesses who've got a great business, who've got lots of money coming in, are absolutely opposed to radical innovation and radical change. So you get in the late 19th century people who've invested all their money in the gas business, deliberately trying to stop the spread of electricity and electrification and the electric light. So all the way through you get incumbent businesses trying to stop innovation, as well as trade unions, and what you have, what's an entrepreneurial giant is somebody who sees a new business that doesn't exist at the moment and brings it into being through the force of their imagination and energy. So the entrepreneur is the driver of creative destruction, but the successful entrepreneur, the person who's got a great business, is also quite often the enemy of creative destruction, because they don't want to be displaced.
Absolutely. I mean, your book goes back and really starts at the beginning of the American Republic and talks about the way that you had these scrappy pioneers who were busy testing everything and had the chance to test everything, came over, if they failed at something, they just picked up and moved on. That part is well known. I think one of the things that's very interesting for me as a British person reading this book is you also reveal the degree to which in the first couple of centuries of American growth, there was an awful lot of what might be called politely borrowing of ideas from...
Stealing.
Well,
industrial espionage.
Industrial espionage. I mean, a lot of ideas were taken from England in those days, or the UK, and brought across to America and either taken or stolen. I mean, did that surprise you? Tell the audience about that aspect of it.
Well, let him answer that question.
Well, there was, as the British half of the partnership, there was a huge amount of industrial espionage. Britain was the preeminent industrial power in the world, preeminent particularly in textiles, in weaving and things like that. And the Americans simply stole our technology. And the British tried to prevent this by searching people's baggage, making sure that they weren't taking over blueprints. And one of these people who did this, who bought over technology, was a man called Samuel Slater, who's known in Britain as Slater the Traitor. And he did all of this espionage simply by remembering. He had this extraordinary memory, and he remembered the whole...
He wasn't allowed to carry any papers, but he remembered the very complexity of how the mills worked, and he eventually started the textile industry in New England, which was a big part of the expansion that the United States experienced prior to prior to the Civil War.
And you get the same thing with the railroads, with trains, as I said, the Stourbridge line, where they bought over the Stourbridge line, looked at it, decomposed it, and reverse engineered it, and then copied it, and then produced their own trains or railroads. And the interesting question is why, one of the many interesting questions is, why is it that America took all of these British ideas, British innovations, and did better than Britain did with them? So Britain is, in the mid-19th century, this incredibly powerful country, the world's biggest producer of steel, for example, or iron, and the preeminent cradle of the Industrial Revolution. But very rapidly, it's surpassed by the United States, because the United States, first of all, gets hold of these ideas, reverse engineers them, and then picks up on all these innovations and then applies them on a sort of scale that Britain just never manages to do. So by 1900, Andrew Carnegie is producing, his own company is producing more steel than the whole of the United Kingdom. So it's a very rapid advance by the United States. And by 1900, America is the world's preeminent power, having been in 1850 very subordinate to Britain.
I mean, it's got some fascinating parallels and raises fascinating questions about the degree to which it used to be Japan that borrowed American technology. Now China is taking or stealing American technology. I mean, the parallels and echoes through history are fascinating in that respect.
Oh, I think it's remarkably similar. But you have to remember that China at this point has a per capita GDP in real terms 1/3 the size of the United States. And indeed, what you could describe it as is the American economy in 1960, where steel, aluminum, and all of the steel, aluminum, coal, all of the things that represented that years, that's where China is today. And lo and behold, you go look at the fascinating, steel is a fascinating example here. United States was obviously in 1960 had by far the largest part of the world's steel industry. And it gradually got displaced by other countries coming into play, and currently steel now is virtually negligible in the United States. China has taken over the whole structure of it. And it's true about a lot of things, because China now looks like the United States in 1960. And we, in some of our policies, are trying to replicate 1960, failing to realize that we'd have to go back to a much lower standard of living. And this is one of the fascinating aspects of the history of this country, in that it was not always clear it would come out that way.
Your point about Japan is extremely interesting because in the 1980s, America was absolutely obsessed by Japan. They thought that Japan was going to take the lead in this, that, and the other, particularly in technology. And then it faded very rapidly, and America reasserted its lead in the cutting-edge technology. So the big question is China Japan, or is China, as it were, the United States to the American senescent Britain? I don't know which is the two it is.
So to go back to my original question about whether you think that the government today is willing to accept creative destruction, when you look at what's happened, say, with steel in America, and you see how essentially it's moved to a country like China, do you think the governments today should just accept that there are parts of the economic industrial structure that are gone? They've been destroyed, it's time to create something new and move on?
Well, if you want the standard of living to continue to rise, what we do in this country still to this day is allow the markets to determine what leads to maximum productivity. And so that what we're seeing now is this, what I mentioned before, the dramatic shift in what it is we produce and what we do value added. My good friend, what was his name, Walter? Well, what's the name of the book? On innovation.
Oh, Robert Gordon, you mean?
No.
Oh, Walter Isaacson.
Yeah, Walter Isaacson wrote an extraordinary book and on the innovations that are occurring, and I learned a great deal about the whole process of how we got here. And here is the fact that we have this extraordinary basic advanced system which is wholly different from what we were back in 1960. And that means there's an awful lot of creative destruction that occurred from 1960 to date, and it shows up sort of fascinatingly in the parallel of China actually coming up to 1960 in today's markets.
So do you think it's a huge mistake to try to impose tariffs?
Try to do what? I'm sorry.
Impose tariffs.
On the trade
Well,
side?
let's remember what a tariff is. A tariff is a tax. It's an excise tax. And when you have say a trade war, which is where we're getting into today, tariffs, because they withdraw purchasing power from an economy, means that it's deflationary. And so that if you have two countries in a trade war, both, by definition, are deflating their economy. The winner of that trade war is the one who does least worst.
Yeah.
And that's basically what we're looking at this particular stage.
One of the most depressing parts of this book is the account of what happened in the 1930s with SmootHawley and the impact of SmootHawley both on the American economy and on the global economy, which was a great attempt to restrict freedom of trade. Worst things ever pushed through Congress.
Oh, that was an awful thing. But you know what created the problem in part is that because the Constitution of the United States did not allow an income tax, that the initial revenues for the government actually were tariffs. And it was a very substantial part of government at that time because it had to finance the whole government. And I'm fearful of fact, you look back over the decades it's quite apparent that tariffs were not considered all that negative until we got into the 1930s, and sort of the SmootHawley tariff was a fascinating point in American history, and we take a good deal of time in discussing
well,
what
obviously
the implications were.
It's very, very
where President
relevant.
Hoover
very relevant for today. I'm curious because the issue about creative destruction today really revolves around two issues. One is, and I'll take them in turn, the first is robots and automation. Because if you are going to embrace creative destruction today, you should embrace a vision whereby robots and automation could displace many thousands, tens of thousands, millions of workers. And that's leading to greater populism,
Indeed,
insecurity.
yeah.
Do you think there's any way to persuade Americans today to embrace creative destruction in that sense without creating political tensions?
I think there's actually a broader problem here, in the sense that economic technology continues to advance in the United States, and it necessarily means as the economy becomes ever more complex, fewer and fewer people can know how to run it. And what that generates is a significant skewing in the distribution of income. Because if let's go back to Euclid. You go Euclid to Einstein. It's not obvious that the intellectual capability has changed all that much. The outer edge of our best thinkers is all approximately the same as best. It's very interesting. You go back to as I say, Euclid. You can go back to the earliest mathematics. Starting from scratch, that was actually far more complex than what we would do today relative to where they came from. And so that if you have a flat, just an upper echelon of how smart human beings are, then obviously as an ever-increasing technology requires more and more conceptual human beings, you start to find the need to go beyond that, and that's where robots come from. And what bothers me when you look into the long-term future, a significant part of this is how in the world, if an ever smaller part of the population is capable of running the system, which is highly complex, that you avoid what a market will do, namely disproportionately move incomes to a very few people. And when we're talking about robots today, we're talking about the early stages of this problem. I try to look into the future, and I don't know where it leads us, but I know what the trend is, and I know where the limits are. And unless human nature changes, which it hasn't for a while, we've got a problem ahead of us, not in the next decade or the next 2 decades, but if productivity continues to advance and makes the system ever more complex, fewer and fewer of the people employed under it can make it work, and those who can make it work get a very substantial, disproportionately large amount of the gross domestic income.
Sounds like the recipe for a revolution.
Well, it's that sort of thing which has created revolutions in the past.
Can I ask them about one other aspect about creative destruction, which before I turn to the questions, which is if you want to have proper creative destruction, real free market forces, you should also have proper financial creative destruction. Are you concerned that in the current system we have of too big to fail, government support, are you concerned that we don't have enough laissez-faire finance to have proper creative destruction? Or do you think that finance is one area where you need to have some controls over market forces?
No, it's all cool, Jonas.
No, I think you should answer this.
No, but we basically see it all the time, that in finance, as in non-finance, there is a considerable amount of creative destruction. Just go back, say, 20, 30, 40 years and see what the financial markets were doing and what the big issues were and what the yield spreads were and all the usual stuff which we financial types, love. It's very obvious that there's a considerable amount of creative destruction going on in finance as well as non-finance.
But do you think the government is meddling too much in the markets to let it play its course?
Well, not really. I mean, it could be, but it's turning out that where you needed to constrain the system, that's where we get laws, which have essentially done that, most of that.
What about the equity?
What do you mean?
What about the equity ratios in the banks to prevent, so that the banks bear the burden of...
yeah, one of the things in the book they're really, because you're getting this extraordinary change, one of the things we have found is that the rate of return on equity, whether it's in stocks, bonds, real estate, anything, is essentially remarkably constant. The reason for that is that there's an aspect of human beings which we call time preference, which is the extent to which you discount the future relative to the current period. And what that necessarily implies is that interest rates, which is a most important aspect of this particular human propensity, would be constant. And lo and behold, you go look back in history, and interest rates in 5th century BC Greece were pretty much where they are today and have been in the last generation or two. And what we're dealing with is a situation in which the equity part of the economy is being governed by that. Why don't you take over and...
Well, so the principle really is that banks should be required to have much bigger equity buffers than they have at the moment, and that would mean that that would tend to stabilize the system. The problem with creative destruction in finance is absolutely wonderful, it's marvelous, it's very important for creativity that it allocates resources very quickly, very efficiently to areas where they're used best, but also overcompensates on the destructive side, as we've seen over and over
booms
again.
and busts.
Booms and busts.
Yes.
So what you need to do is force banks actually to keep more money back, and rather than going cap in hand to the government to be bailed out. So I think that would do a lot to prevent the destructive side of creative destruction when it comes to finance.
So everyone needs rainy day reserves.
Yeah, exactly.
This gets to the particular point of the fact of what causes these financial crises all along, and it's contagious defaults.
Yeah.
In other words, it's one financial institution defaults and then another. Why? Because it doesn't have enough equity.
Right.
So the question I've always wondered is, why do we distinguish between finance and non-finance? The non-financial part of the American economy, and indeed pretty much around the world, doesn't have that many defaults. Why? because, for example, the United States, in the American corporations, the average ratio of equity to assets is 40, 50%.
Right.
And now we have this other set of institutions which do the same thing in principle, but operate as banks or other financial intermediaries. And one of the things that I really never quite understood why we do it this way is, why do we distinguish between the two? I mean, the issue is, in finance, it's supposed to be this contagious default. It's one
Right.
bank fails, then it forces another one to fail. But it's the way the system works. If the rate of equity to assets is low, it's got nothing to do with the type of assets that are dealing with.
Right.
And so I would argue that we shouldn't be making these distinctions. There should not be charters for banks, which means they can hold a very small part of their assets as equity. If a non-financial corporation
Right.
did that, they'd go bust pretty quickly.
So stop treating banks like they're something special. We have a lot of questions here. So let me take them one by one. First question is, are we in a bubble? Are we due for a recession?
You want me to answer?
No, you answer that.
So,
Yes.
Well,
It's above my pay grade.
a bubble,
so are we in a bubble, Chairman Greenspan?
bubble by definition is an expansion of speculative, usually with speculative basis, which will burst. So by definition, you're talking about a very special class of events. And I don't think there's a bubble in the sense there are imbalances very substantially. I mean, we're talking about stock market bubbles, but at the moment what we've got is a bond market bubble, where bond prices are inordinately high, and we're now beginning to see the effects of as interest rates go up, bond prices go down. And it's bubble, yeah, I guess so, but it's not what we usually talk about as a stock market bubble.
So it's a bond bubble.
Yeah, it's a bond market bubble, but you can very readily convert one into the other, depending on how the markets behave. But I don't think the problem we have at the moment is a bond market bubble. As we say in the book, I believe, we talk about the conditions of how do you prevent crises?
I mean, we're much more concerned in this book, not with more recent bubbles, but with the slowdown in the rate of productivity growth of the US economy. That the US economy, which we argue has been one of the most dynamic in the world, since about 2000, perhaps a bit before that, has been fairly stagnant. There's very, very low productivity growth. It's been sort of almost caught trapped in a swamp. And that really is worrying. It almost as though the sort of the animal spirits that America has that kept it growing for a long time have been dulled. If you look at all sorts of measures such as social mobility down, geographical mobility down, people are much less inclined to move around the country than they used to be. The creation of new companies down, the entrepreneurial spirit rather dull. There's all sorts of measures that indicate that America's become a much more regular country, much more like a sort of a slow-growing European country than it used to be. Its distinctive features have been dying. We try and explain that in terms of the growth of regulation, the impact of the financial crisis, and the way that entitlements are crowding out other forms of investment. And what we argue is that it's not the case that America is necessarily doomed to becoming a slow growth economy. This is a policy choice, that it's actually chosen to do a number of things which are very foolish, and it can get its growth rate back up if it's willing to reform its entitlement system, reform its regulatory system, and reform its financial system in the way that the Chairman Greenspan just explained. So it's possible to regain this American dynamism, but at the moment, American dynamism is dulled, and because it's dulled, you get the rise of political antagonism, political populism, gridlock in Washington, anger in Washington, and the rest of it. So that's much more of the essence of our argument than the argument about bubbles. Yeah.
Do you think that the current administration policies are supporting the kind of medicine that you suggest to reinvigorate the American economy?
I'll be more specific. What?
Well, do you think, for example, that the current tax cuts under President Trump and the deregulation is what you need to revive the economy?
Well, let me say the answer is yes and no, like most questions in economics. Ireland managed to create a major advance in what was a relatively stagnant society by lowering its corporate tax rate from 35% down to 12%. And I believe, but I don't know for certain, that it's that model which is creating the existing tax pattern. My view is that that's the right thing to do, provided you fund it. The result of that is going to be a very large federal budget deficit. And federal budget deficits invariably down the road, without qualification, engender inflation. At the moment, we have the tightest labor market I have ever seen. That is, the number of job openings is significantly greater than the number of people looking for work. And that must inevitably begin to push on wages. It always has, it always will, but it's always delayed. And my view of that is that something has got to give. And that's, I don't know where it all comes out.
Well, you're implying it comes out with inflation.
Well, the problem basically is if we do nothing, we're going to end up with probably stagflation, which is an inflation rate, or I should say, it's partly stagnation, which
inflation
is measured in very significantly slowed output per hour. Output per hour now, which used to be 3-4% per year back in the early post-World War II period, is now under 1%.
Which brings me very nicely onto the next question from the audience, which is, someone has asked for you to share your thoughts about President Trump's recent criticism of Jay Powell and the Fed.
I would like him to answer that, but I'll answer it. I think it's very short-sighted. The issue of the Federal Reserve is required by the Congress to maintain a stable currency, which means no inflation, no deflation. And the policy they're embarked upon at the moment seems very sensible because, as I mentioned before, the wage rates are beginning to show signs of moving, and you cannot have real wages rising without it ultimately falling into the price level. So that I think if they continue on the road that we're going, I should say that the president wants to go, we're going to end up with a very significant budget deficit and very significant inflation. Ultimately, not not in the short term, because it takes a while. Political system doesn't care about deficits. What they do care about is inflation. When the inflation rate was 4% in the 1970s, President Nixon imposed wage and price controls. We're nowhere near there yet, but we're on our way.
If we are, though, heading towards a potential rise in inflation, rise in debt, at a time of growing populism, do you think there's a chance that the Federal Reserve will lose independence?
I'm sorry, I don't follow you, what you mean.
Well, do you think there's a chance that Congress or the President will try to control the Federal Reserve or take away some of its independence?
I really don't know. It's one of those forecasting aspects which is difficult.
Another question from the audience. As the Federal Reserve's reach grows, do you think that legislative oversight will become necessary?
Again, that's above my pay grade. So,
Or do you think that Congress should exert more control or oversight of the Fed?
I think the Federal Reserve is by statute. Remember, it's the Federal Reserve Act of 1913, which essentially did something very unusual. We had a long period, and we discussed this in the book, in which financial crises kept surging up and then collapsing, which is a typical cycle which went on for decade upon decade. And the populism that evolved as a consequence of this looked ever increasingly to find a way to solve the problem of why the crises occur. And the general solution was, if the economy is accelerating and it's running out of gold specie, then you're going to get into a situation in which there are always going to be crises. So what the Federal Reserve Act actually did was very interesting. It substituted the sovereign credit of the United States for gold. And even though we stayed on the gold standard technically, that was a major change in American financial history. And the basic consequence of that is that the Federal Reserve determines what, in effect, is a sensible level of money supply expansion. And one of the reasons the Federal Reserve Act was actually passed was to prevent the political system from becoming so very dominant in determining monetary policy, which is exactly what you don't want to happen. And I mean, I was, 18 and a half years, as you mentioned, getting letters from everybody who, one way or another, congressman or otherwise, who want the issue of, and don't worry about the issue of inflation. And nobody was, I mean, what I would be getting, people who say we want lower interest rates. I got tons of that mail. I never got a single letter saying, please raise them. And it tells you that there are some views which go against reality, and reality always wins.
but if you look at the history of populism, some of the worst populism you got was in the 1970s. Some of the anger that was generated by inflation in the 1970s were roiled right the way through the political system, and eventually leads to the rise of Ronald Reagan, and who comes in and then crushes inflation. So inflation is not a solution to populism. It makes people very angry.
Do you think the current populism is going to get worse, Chairman Greenspan?
Well, let's remember where populism comes from. I don't know whether this is a general proposition, but I find it's difficult to get around the answer that when the inflation rate, or not the inflation rate as much as the levels of income slow down, when you get productivity, for example, which is the major determinant of income, when you get productivity slowing down, you get a much lower increase in GDP and gross domestic income and wages and salaries and like. And there's a great deal of unease in the population, which is saying, things are not good, somebody come help us. And somebody, necessarily on the white horse, comes up and says, I've got the way to handle this. And if you look at Latin America, the history of a goodly part of Latin America is a remarkable amount of people like Perón coming in and all the subsequent post-World War II governments in Latin America. And it's really quite unfortunate and surprising. It's not that they try it and it fails, which it does, it always fails, but it doesn't eliminate the desire to do it. In other words, Peru, Brazil, and the like, they've all undergone very significant periods of huge inflation and collapsing, and nobody learns a lesson.
Yeah. Well, we're almost out of time, but there's one other question from the audience, which I think cuts to the heart of a lot of what we're talking about right now, which is this: does the success of capitalism come at the cost of enormous wealth disparity?
Okay.
Is it possible to have this vision of creative destruction, of capitalism, of dynamism, without having massive income inequality?
I doubt it. And I doubt it for the reason I said earlier, namely that we've got the problem that human beings don't change, but technology, as it advances and it's embodied in the growth of an economy, is always growing. And when you have something that's growing and another thing that's flat, you get obviously inequality and the political consequences of that.
Can I qualify that just a little bit? I mean, there are different sorts of inequality. There's the inequality that you get from somebody like Bill Gates or Steve Jobs producing a fantastic new innovation, an idea, which means that they reap a lot of rewards for that, but which means that society as a whole gets richer and better off. And there's the inequality that comes from crony capitalism, from people using political influence, blocking innovation and sucking out undue rewards for themselves. So I think we need to be absolutely very, very sensitive to the wrong sort of inequality while celebrating the right sort of inequality. And also I'd add that Joseph Schumpeter, that great man, once said that the nature of capitalist progress doesn't consist of queens having 1 million or 2 million pairs of silk stockings. It consists of what used to be the prerogative of a queen being spread throughout the whole of society. Silk stockings, you know, go from being very rare and only worn by queens to being worn by all sorts of people all over the place. So it's the nature of capitalism is to create new innovations which are at first rare, but spread throughout the whole of society and everybody uses. So if you think of the iPhone or something like that, that was something that was incredibly rare. Only a few people had those sort of communications devices. Now everybody carries them around all the time. And the great capitalists, the Bill Gates, the Steve Jobs, don't get rich by selling one really, really good iPhone to one person. They get into selling the products to all sorts of people. So there's a sense in which there is no real trade-off between very rich people getting very rich and the rest of society getting better off. You know, they only get rich because they create things which everybody or most people want to have and buy. You know, it's the silk stocking question, really, I think.
Right.
You know, I accept that qualification.
Yes.
Okay.
And I mean,
let me just say one thing. You know, going back to I was mentioning Walter Isaacson's book on innovation. He wrote that book, and I remember reading it, and my final conclusion was, and I asked him, why is it that all this innovation is in the United States? It's American. And he said, I've never thought of that. I don't think he was aware of the fact that he had all of these innovation developers, and they all turned out to be American, which leads me to conclude that there's something fundamental in the psyche of American history and the American public which creates it. It's not an accident.
Which is what you've
It's happening too often.
So, which is what, of course, you sought to explain in the book. So, if you had a chance to take this book into the Oval Office today, or into the Treasury, and give it to the President and say, this is the history of America, here are the key lessons, what is the top bit of advice that you would give to the administration today to keep capitalism growing in America?
Well, we haven't mentioned that there's an underlying financial problem which we haven't addressed. And the best way to discuss it is when I first became aware of it, I happened to be looking at data and accidentally created a chart which showed the relationship between entitlements spending, which is social benefits in the rest of the world, and gross domestic savings. And from 1965 to the current period, the ratio of entitlements to the sum of those two is flat as a percent of gross domestic product, which means, or at least implies, that one is crowding out the other. And when you look at the individuals, they are actually looking different. I mean, one goes up, the other goes down, and so forth. And I think that's suggestive of the fact that there is something in the sense of when we say that entitlements, which are rising in the baby boom generation,
Right.
is essentially crowding out gross domestic savings, which in turn, coupled with the borrowing from abroad, is how we finance our gross domestic investment, which is the key factor in productivity.
Right. So, entitlement reform. Well, I look forward to a tweet about entitlement reform. I look forward to this very important book being part of the discussion about how to keep America's economy great and growing. But in the meantime, thank you both very much indeed for sharing your thoughts. It is indeed a fascinating book and quite an achievement, and best of luck in getting this very important message out. So thank you both very much indeed.
Thank you.